Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending actually the end of June. We're going into July, so this is going to be a look at what we're expecting going into July. Here's the S&P 500 on a 30-minute chart. We had a really good week this week, so that wasn't quite unexpected. I'm going to show you one of the first posts this week. Actually, my very first post this week, or this past week, Monday morning, discussed window dressing, and I had a total of 16 posts this week that discuss window dressing. That's just the ones that do discuss window dressing. I have a lot more throughout the week, so I post quite a lot. But let's take a look real quick at one of the posts from Monday. Being the last week of the month and quarter, it is likely we see window dressing, or the art of looking smart, in which hedge funds and others buy the best performing assets of the month and the quarter. So when they give out prospectus, it appears to new potential investors that they owned all the best performing stocks of the quarter, even if they simply bought them the very last week or last day so they could report them as holdings. They also, by the way, can drop, or often do drop, some of their worst performing stocks, part of window dressing as well. That could drive some window dressing buying in the same stocks we've been seeing signs of institutional distribution. So the best performing stocks on the quarter are generally the ones they're going to buy into the end of the month and the quarter. If you didn't get it already, this has nothing to do with their convictions or beliefs of what's going to go up. This has everything to do with, as I say here, the art of looking smart, so they can make it appear that they owned the best performing stocks of the quarter. As of the end of the quarter, that's what they report, their holdings. And now we will take a look at the very last post of the week that had to do with window dressing. So this is Friday. The top three sectors for the quarter: tech, consumer discretionary, and communications, in that order. By the way, they're all mega cap heavy sectors, are the top three performing sectors today in that order. The worst performing sector of the quarter, utilities, is the second worst performer today. The third worst performer of the quarter is the fourth worst performer today on Friday. It's uncanny, but exactly what the very first post of this week warned we'd see. Buying the very best performing stocks and sectors of the quarter and selling the worst. So this actually left the charts looking pretty good going into July. In July, next week, tomorrow actually, is going to be a holiday shortened week. In the US, we have Tuesday off for the 4th of July. And let me show you the chart real quick. And if you're ever in doubt, the ticker is up here, the S&P 500. The time frame is up here. So this is an hourly chart of the S&P 500. If you're a subscriber, or if you've been watching my videos, I've thought that a close above S&P 500, 4,200 level, which was right here, would drive a really strong rally based on hedge funds and institutional funds that didn't believe this rally from October, that are playing catch up, fear of missing out, and short covering. So what I've pointed out a lot of times is we had this 8-week range where the S&P 500 came just 35 points within 4,200. It took 8 weeks to get there, 35 points. After we closed above 4,200, it took the S&P 2 weeks to add 250 points. This is why that 4,200 level was so important. We've been bullish this rally the entire time, but my view has been, based on my outlook for the economy and the macroeconomic outlook, has been that we would rally right into the end of Q2, which was the end of June, and then we would start to transition to a different period in which the market is no longer rallying on peak Fed hawkishness and peak rates, but is starting to get more concerned about an economic recession. As far as the reasons for driving this higher, another thing I talked about was a record short position in S&P futures among the non-commercial large speculators. That means hedge funds. And what I've been pointing out, hopefully my marker works here, is that we had the largest short position in S&P futures in the history of this data series, which goes back much further than 2016. So a lot of hedge funds have been short the S&P 500. A close above 4,200 means they are starting to lose more and more money, and they will be covering shorts. When you cover a short, you buy to cover. In the market, it looks like a buy order just like any other, and it drives prices up. That causes a short squeeze. So we'll take a closer look at this chart and what has happened over the last 4 weeks since the S&P closed above 4,200. Okay, so this is just a closer look. Here is the all-time record short in S&P futures. Each one of these bars is 1 week. So our close above 4,200 came right here, and we saw what? Short covering every single week. That has largely driven a big rally in the S&P 500 over the last 4 weeks, exactly as expected. If you are a subscriber to my website or you just keep up with my videos, then you probably know that the most hated stocks of 2022, when we did have a bear market for about half of the year, were mega caps. And our call was that they were going to go from the ugliest and worst performing to the best performing as of the start of January 2023. Okay, so we've got 2 quarters in the books. That is H1, or the first half of the year. And the Nasdaq has put in its very best H1 first half of the year performance in 40 years. You can see we've had some very, very bullish price action. This was actually our measured move from this bull flag. We met it, and as always with measured moves, price tends to consolidate right after that in the area of the measured move. Let's take a little closer look. And looking at this, if you saw last weekend's video, what I talked about was a bunch of bear flags that we saw intraday. This one's like 2 days the prior week. And this is kind of the first time in basically all of 2023 that I've started to see these, but we do have an ultimate formation that is still bullish here in this big bull flag. What is really important is a decisive breakout. So for Nasdaq 100, this actually looks pretty decisive. As of Friday, we get this big gap up. Again, why? Because we do have window dressing and everybody's buying the best performing stocks and index. Now, to be a definitive breakout, we need to see basically a strong breakout to start with, and then across above this former high that started this whole consolidation. This is really the most dangerous place in a breakout, or if it was a bear flag in a breakdown, it's the most dangerous place until you have a definitive breakout. Otherwise, the risk is of a failed move that leads to a fast reversal. I'll show you one of those in semiconductors in a minute. Actually, I'll show you right now. So this is the Philly Semiconductor Index on a 30-minute chart over here. I have a little highlighter. This is a bullish ascending triangle with a perfect measured move that was 20% right here. Get another bullish ascending triangle, and this is what I call a less definitive breakout. Gets about 3% and then rolls out or rolls over. Once it crosses below this apex, that's a failed pattern, and we get kind of a back test up into that pattern this week. Not uncommon. This area is the highest risk for a failed breakout, and failed breakouts, you can think of it as a bull trap, often tend to lead to fast reversals. In any case, going back to the Nasdaq 100, and we'll take a closer look at a lot of these at the end of the video, but we don't have a definitive breakout yet, but we have a nice start to the breakout. We didn't see that everywhere in all the averages, and I'll cover some of those as we move forward. But the big takeaway is Nasdaq has its best first half of the year in 40 years. However, this also kind of aligns with what I've been thinking since before this year started, that we would see this rally from October to now to the end of Q2, and then we would start to see a change in tone. The way I've laid it out is phase 1, which is the rally, phase 2, which is the market starts to get more concerned about recession, and then phase 3, ultimately, we go through a bear market again based on the recession, and we bottom out and start a new bull market. So why have I held this view that Q2, the end of Q2, would be a definitive or really important area to watch? It has everything to do with my macro outlook, which I've held since before 2023 started. my estimation of how high the Fed would take rates and the reasons why, how long that would take, and how long the monetary policy lag takes until it hits the economy, which I've done some recent videos on. The reason Q2 or the end of Q2 it's been my hypothesis that we'll see that transition is because of the lag in monetary policy. My opinion, from what I've seen in 25 years of doing this, the lag of monetary policy, so when the Fed hikes rates, before it actually hits the economy and the economy feels it, is 6 to 12 months. Now the Fed's President Bostic has done a paper and he says it's 18 to 24 months as far as what it means for the market. As I showed about a month ago, the effective rate of the Fed funds policy that the economy was feeling was less than 1%, even though the Fed funds rate is at the 5 to 5.25 corridor. As those months go by, the 6 to 12 month lag, the economy feels those rate hikes more and more and more, and my estimation was that we would start to see that really hitting the economy in the second half of 2023, which starts July 1st. If you read this over here, and I've put in the years 2023 and 2015, if you read what it says, basically it says in 2015, the top 10 stocks, right, in the S&P 500 accounted for 17.3% of the S&P 500's market value. As of June 20th, 2023, top 10 stocks account for 31.7%. So you can see it here. In 2023, top 10 stocks, 31.7% versus 2022, top 10 stocks at 17.25%. Look at some of these leaders, okay, the most heavily weighted stocks in the S&P 500. So you have Apple, you have Microsoft, you have Alphabet, A class and C class, you have Amazon, Nvidia, Tesla, what used to be Facebook, that's now Meta Platforms. Now, we did make the call that the mega caps would rally into 2023 and that they would provide leadership, which they have done and which we've even seen in window dressing this past week. I'm going to show you another chart that just kind of really displays how much mega caps have been in control of the market in 2023 so far. The S&P 500, that is in the candlesticks, the red and green candlesticks, and the other thing is my own equal weighted list index of mega cap stocks. I think it is important to point out that this is an equal weighted index, this white one, whereas the S&P 500 is a cap weighted index. So they actually have more influence in the S&P 500. But as you can see in 2022, where we had the bear market, the first, well, going right into October, you can see that the S&P 500 and the mega caps track pretty similarly. They actually were really horrible performers, and then we saw a bunch of tax loss selling in the mega caps late in December and a little bit November. Actually, just the ugliest thing, right? But in January, they take off and they are leading the market higher. I'm not going to get into why right now, but we had a thesis as to why, and it was exactly right. And you can see over here, they're leading the S&P 500, these dozen or so mega caps. And you can see this even more dramatically if we look at the S&P 500 equal weight index that's not cap weighted. So here's the same thing, my mega cap index really underperforming towards the end of the year, really outperforming into January. And you look at the S&P 500 equal weight index that does not benefit from the mega caps exposure or their very heavy weighting. It's basically done nothing. It hasn't even gone up here to retest the January high. But what this is telling you is that the benchmark index, the S&P 500, is extremely reliant on less than a dozen stocks, while you have the rest of the S&P 500 that is not doing as well. Here we have a similar chart. Again, it is the S&P 500, but this time I have an equal weighted index over here of cyclical sectors. These are the ones that perform the best in a new economic cycle. So they actually performed really well, led the rally off of October, but since then have not done much at all. It's been the mega caps, remember, that rotated into January. So the cyclical sectors, money came out of them and it went into mega caps. You can see they are not acting well here. If we look at the defensive sectors, what you can see is a similar theme. As we come into the new year, you can see money coming out of these defensive sectors and it's going into the mega caps. But that also makes for a thinner market that is reliant on a dozen stocks. Now, this isn't anything new. This is exactly what we expected before the mega caps rotated in, that we would see money flow out of all these other stocks that had supported the rally from October into mega caps, making for a thinner market, or market breadth or participation, which we have seen. So the important question now is what has happened in June? Because my expectation or my suspicion was that we would start to see money coming out of those stocks that have performed astoundingly well in 2023. You have the Nasdaq 100 up 40%. And for that, we go to my proprietary indicator 3C, which is a money flow indicator. It has the power to contradict price. What I have suspected we would see in June is a process of distribution, which is selling into stable or higher prices. Okay, so we're looking at a 2-minute 3C chart of the SPY. So here's the SPY. 3C is in orange. Unfortunately, I can't get enough intraday data to scale this correctly. The point is 3C was tracking perfectly with price until we came into June right here. Then it started to negatively diverge. We have the Fed pausing rate hikes right here. What do we see? More negative divergence. We get this little bump into the end of the quarter, which again is, in my opinion, completely related to window dressing. Taking a look at small caps, I thought maybe small caps could rotate in June because we started to see some evidence of that. But that was only the first week of June right over here. Sorry, I used the wrong tool here. But what you can see, let me change that. What you can see is 3C really positively divergent into this low over here, and we get this huge run. I think it was about 7.5% for small caps the first week of June. Then we saw a transition right here on the 7th to mega caps. Small caps really needed to consolidate, so it was no problem in my opinion. But since that consolidation has happened, we've seen weakness or weaker tone in 3C over here. If we quickly look at a price chart of small caps, and again, this is a 15-minute chart of IWM. Here's June 1st. You can see that big run, and then we have this bullish consolidation trend line. In last weekend's video, what I pointed out was the change in tone, not only breaking below this support trend line of this consolidation, but doing so every day in little bear flags every single day. Now, this isn't a huge bear flag. It's not like, okay, we have an imminent, market crash coming or anything like that. It's a change in tone, a change in character, and that was the theme of last week's video. Changes in tone, changes in character precede changes in market trends. But a lot of people don't pick up on these little things. And here we had kind of a bear flag coming into this week, and I'll show you why. And then basically kind of this rally right up to this area. So it has not done anything technically that's improved its posture or made me think, okay, small caps are going to do better. It's just seen a little bit of the same thing we've seen all week, which is basically a strong market this last week in price. The small caps are exceptionally sensitive to the smaller regional banks, which we all know with SVB and all that had a lot of trouble. If we look at the same chart, basically same time frame and everything of regional banks, what you see is the exact same thing. June 1st, really strong run, then a bull flag, which is very bullish as of this point. And then last weekend's video, I showed you again a breakdown, a failure of this bullish flag. That is a change in character. That is not good. We have a bear flag here. My call to subscribers, the website all this week was that When a bullish pattern like this is broken, as we saw the prior week, it often is back tested. So price would back test into this lower trend line, which happened, and that's exactly where prices have failed. So if regional banks don't do better and they don't look good right now, then small caps are not going anywhere without them. But what is most important is the stocks that have led all of the first half of 2023, the mega caps. So we look at their 3C charts. I think you'll see a theme developing. Here is former Facebook, now Meta, and really a nice confirmation of the uptrend over here by 3C. 3C is moving up with price. As we get into this gap up over here, what we are seeing is a negative divergence, which in 3C's vernacular represents distribution, selling into price strength. This is what I'm talking about when I say 3C has the ability to contradict price. So here is Apple, and unfortunately, again, I do not have enough time frame here to properly scale 3C, but the gist was that it was moving pretty well, and then we saw some distribution over here, and then since then we've seen more distribution or selling into price strength. An interesting thing about Apple was that this week it was trading just like $1 away from a $3 trillion market cap. You've heard me in this video talk about the importance of whole numbers like S&P 500, 4,200. And what happened at that level once we had a close. So the human mind, mass psychology, and price of these charts is just a representation of mass psychology. The human mind is gravitating towards whole numbers, always does. So if you walk into a store, something's on sale, instead of $100, it's $99.99, or instead of $10, it's $9.99. Now the 1 cent is just irrelevant. Psychologically, because our minds are drawn to whole numbers, it's actually very effective. So Apple was trading just below that 3 trillion market cap. I think it needed to hit 190.75 to do it. We got Citigroup on Thursday or Friday morning, and it started coverage of Apple with a buy rating at $240 price target, which is the highest on the street. That got Apple to gap up and easily hit that $3 trillion market cap. But if we take a look at Apple, what's been happening here, we can see on this 2-minute chart what's been happening. Here is Apple on a 3-minute chart, and keep in mind with 3C, what happens is the most sensitive time frames, the shortest ones like 1 minute, 2 minute, will show a divergence first. If that divergence grows or becomes more powerful, it will start to migrate to longer time frames. So over here where we have kind of a double bottom, we have a very positive divergence in May in Apple. Here's the distribution day. But on this time frame, we can start seeing a negative divergence, and we're going right into the Fed's rate pause, which is where I expected these things to kind of accelerate. Now on a very strong 5-minute 3C time frame, what we can see again, that accumulation right here into May, right? Nice positive divergence here in 3C. But as we are coming into the end of the month, look at what is happening. 3C is not confirming. This doesn't mean that short sellers are all over Apple and Apple's going to crash. It means that all the support that we had here that drove prices up is thinning out. We're seeing institutional money, because they're the only ones that move charts at this time frame, taking profits. They are taking gains out of the stock, which means they're no longer sponsoring or supporting it. Doesn't mean the stock's going to turn around and crash tomorrow, but it is a change in tone, a change in character, which precede changes in trends. Here is Google, and this is a 3-minute 3C chart, negatively diverging into this area. But where is that? June 1st, right here, the start of June. Here are the Class A shares of Google. What do you see here? Again, a really sharp divergence into the start of June. Here is Tesla. Again, 3C, perfect, beautiful confirmation of the rally. 3C's moving higher, making higher highs, higher lows with price. We come into June, and especially right here around June 14th, the Fed pauses rate hikes. And what do we get? Again, the same theme being seen over and over and over on all these mega caps. Now, that's not to say all of them. So, for example, Microsoft here looks pretty decent still. We do have a little negative divergence there. That's a 5-minute chart. If we go down, look a little closer time frame, a little more sensitive. On a 3-minute 3C chart, we kind of see the same thing, a little bit of selling into this high here, but Microsoft doesn't look horrible. So it's not like across the board, like everything is falling apart, but it is definitely that change in character, change in tone we expected. And, you know, after a 40% gain in the Nasdaq 100 in 6 months, you would think, yeah, there's probably going to be a little profit taking. But this, in my view, is related to something completely different than just profit taking. It's what happens the second half of the year. So for this, let's go back to my very last post of the week, Friday's afternoon update. And what I want to point out here is what I said in this highlighted little area. The Nasdaq 100's up 15% for the quarter, 38.75% for the year as of the time I wrote this. It's been the best first half for the Nasdaq Composite since 1983, which is remarkable given that it has occurred in the midst of an aggressive tightening cycle by the Fed and a string of 14 straight monthly declines in the leading economic indicator index and a recession in the manufacturing sector. So remember, it's been my view, based on my own analysis since before 2023, that we would see a change in the U.S. economy the second half of 2023. Picking up on this leading economic indicator index, basically it provides an early indication of significant turning points in the business cycle and where the economy is basically heading in the near term. So let's take a quick look. While we revised our Q2 GDP forecast from negative to slight growth, we project the U.S. economy will contract over Q3 2023, which just starts in July, to Q1 2024 period. The recession likely will be due to continued tightness in monetary policy and lower government spending. Exactly what I've been saying, that the Fed's rate hikes have a lagged effect of 6 to 12 months on average. Fed president says 18 to 24 months. Either way, let's take a look at the indicator itself. So what you have is the years down here, 2000 to 2023. Okay, you have the year-on-year percent change in the leading indicator, which is blue, and then the year-on-year percent change in real GDP. These gray shaded areas are recession. The last one was this brief COVID crash right here. If you pause and take a look at this chart, what you will see is the leading economic indicators, the LEI, tends to lead the economy. So you can see over here, leading it into recession. You can see over here, leading it into recession. And what have we had? 14 consecutive months of contraction. This is not information I was privy to before 2023. This just came out. Okay, this is the last 14 months. But it aligns with my viewpoint. And this is really not just the US economy. A lot of global economies, China, Europe. This is a chart of Europe's macro surprise index. This little period right here is the biggest collapse in Europe's macro data on record. So the point I'm making is that I do believe this phase 2 is probably very likely into the second half of this year, and it's going to look very different than the first 2 quarters of this year. So let's kind of wrap this up with a quick summary. Here is the Nasdaq 100 15-minute chart, and we can see this week, here's Friday, we have a breakout. This looks pretty definitive, but until we cross above this area right here, it is not definitive, and this is really one of the most dangerous areas for a breakout because failed breakouts tend to lead to faster reversals I believe that much of this that we saw on Friday was the last day of window dressing. And of course, they are buying the best performing stocks of Q2 and Q1, which is Nasdaq stocks, mega caps, tech. I never argue with price action. Price is the most important. All the other indicators to me are just a way of looking at probabilities of where price is going to go. But price action means the most. But at any other point of 2023, if I saw a bull flag in this breakout, I would be very bullish, and I have been very bullish. This is the first time in all of 2023 that I have been skeptical. As we already saw with all 3C charts, we're seeing profit taking in those best performing stocks of 2023. They have less support. This breakout has less support. The one question I do have is, where is the money going? Now, we've seen a couple things for subscribers of where there have been some hints of that, but it's not as strong as like what we saw in December. So here's a daily chart of the Nasdaq 100. This is the all-time highs. This is the bear market that started in 2022. This is the October lows where we basically have seen this whole rally, but Nasdaq didn't participate early on in that rally. In fact, it had the lowest close of 2022 at December 28th. So we saw a lot of tax loss selling, but when we were seeing this decline, we had really solid 3C signals, and that was part of the reason that we made the call that mega caps were going to lead the rally that the Dow had started right here. The point I'm really trying to get at, though, is that sometimes we don't really see that information until we enter the start of the new quarter, which was January over here. So you have window dressing, selling the worst performing stocks of the year into the end of the year. They are free to get rid of those stocks or to buy them or do whatever they want the very first day of the next quarter, but the last day they want to have those on the books to show, hey, look, we were smart, we didn't own this. So based on some initial signals in 3C charts and some really unusual price action in gold, granted it was one day and one day is not a trend, I have a suspicion of where money is flowing to, but we should see that more as we enter Q3. Being that Q2 just ended Friday, we will be seeing earnings season starting basically July 15th, running through August 31st. I think that earnings season is probably going to be very dull, as it was last earnings season, and we're in the summer doldrums. I think the thing that you should really be paying attention to is not what the companies did last quarter, but their forward guidance, given my perspective of what I expect to see in the second half of the year in the U.S. economy, where the Fed rate hikes are starting to catch up and starting to be felt in the real economy. In the meantime, as we go into next week, I would be watching these breakouts very carefully. Any kind of a failed breakout over here, it would probably be exactly what I'm looking for. But for right now, I'm respecting the breakout here, but it's not definitive. When you do have failed breakouts, you tend to get faster reversals. You can think of that as a bull trap. The S&P 500 actually acted a little bit better. So it had this big gap up on Friday, traded above 4,400, traded just above this high, which is where I would call that a definitive breakout. Of course, we do see that huge short covering in S&P futures, but I would again watch this very carefully. With the Dow, there's already some things that changed, that were changes in character, that were suspect. Over here, strong bull flag. Over here, measured move perfectly. We do have an area of like resistance right here. The first hint of some trouble was that this bull flag did not meet its measured move. Then we get the same kind of formation that we see in like the S&P 500, this kind of wedge, and we see prices breaking out, but again, not definitively. Has to cross above here to be definitive. So this is another one I would keep a close eye on. And then we have small caps, like I said before, really strong start to June. Really nice bullish consolidation, but a breakdown, little bear flag, back test into basically that consolidation. That, again, is something that is very common once you have a bullish price pattern like this that breaks down. You often get this back test. Then we have all the window dressing and all that. But this is certainly not a definitive breakout. This is one of the, in my opinion, one of the worst looking averages right now. And go back and look at regional banks. Regional banks have a huge influence on small caps. So for right now, that's going to be it. But I think July is going to be a really important month to confirm the things that I suspect are coming our way due to lagged monetary policy and what I expect to see the second half of the year. I think it's going to look very, very different than the first half of the year, which has been extraordinary, and we've been on board with it the whole time. But things change, and you make money by staying ahead of those changes. So everybody have a happy and very safe 4th of July. Members, I'll see you Monday. Remember, the market in the U.S. will be closed on Tuesday.